Welcome to today's SilverOak quarterly webinar. My name is Shannon King, and with me today is Jonathan Charlo, and I'm going to apologize for my cough. I'm just getting over a little cold, obviously not quite through the process yet, so I'll try and keep my coughing to a minimum, but again, I apologize for that. Today's webinar is scheduled to last 45 to 60 minutes, and a copy of it will be posted to SilverOak's website afterwards. If you have any questions throughout the webinar, please feel free to contact your SilverOak advisor after the session ends. And if you're not currently working with the SilverOak advisor, feel free to contact me directly at 952-896-5701. And of course, I want to thank Jonathan and John and the rest of the SilverOak team for making today's webinar possible. For compliance purposes, I must note that we will be discussing the overall markets and economy during this webinar. In doing so, we will be providing our interpretations and perspectives. You should not rely upon this information as fact when making any investment decisions. Also, we will not be discussing specific SilverOak portfolio performance, as each of our clients' portfolios are customized. Nonetheless, all of our clients should have received their customized performance reports within the past month. If you have any specific questions, please call your SilverOak advisor if your advisor has not yet already contacted you. And lastly, past performance is no guarantee of future success. So with that, let's look at today's agenda. As usual, we'll start with an overview of economic data for the quarter. We'll transition into a discussion on the markets. Now we're going to change things up a little bit today, and we're going to spend the latter half of today's webinar following up on questions that we've received from prior webinars and in prior client meetings. And the first question we're going to address is whether SilverOak's concerned about the increasing budget deficit and outstanding debt. And then kind of a follow-up to that is, how could this impact investment decisions being made? The second question we're going to address is, how does SilverOak decide where to invest money in client portfolios? So those two items are going to be addressed in the latter section of today's webinar. Of course, at the conclusion of today's webinar, we will encourage you to send any additional questions or topics you would like us to discuss in future webinars. So let's transition our discussion to the economy. And Jonathan, it looks like economic data remained strong during the second quarter?
Yes, economic data was strong, but I will point out that it's likely going to peak later in the year and as we go into 2019. So while it's kind of current data, the markets are looking ahead a bit. So we're going to go over in the next few slides underlying data supporting the strong growth, but we're going to do it fairly quickly.
So we'll start with the leading economic indicators, which continue to trend higher.
So LEI, or leading economic indicators, increased again in June. They were up 0.5% to 109.5, and you can see that very strong slope in that curve. But importantly, 7 of the 10 indicators increased during June.
Manufacturing activity also remains strong?
Yes, you can see on the graph that it did tick up. It was actually up in June, up 1.5% to 60.2. Of the 18 manufacturing industries, 17 reported growth, so very, very strong growth.
And also, consumer confidence remains high.
Yes, and I say it remains high because in the last couple of months it did come down. but it was very strong up until March. But when you look at it relative to that long-term average, it's still well above average.
And corresponding with consumer confidence, we have small business confidence that is at a high.
Yes, it did decline a little bit. You can see that on the far right of the graph. It fell by 0.6% to 107.2. But I do note that this is still the 6th highest recording in the survey history. So small businesses are optimistic relative to where they've been historically.
And of course, all of this is corresponding to high earnings.
So here we're showing Q1 earnings, which were up 27%. And so far in the second quarter, we've seen very strong earnings reports. And you're going to see that they rise in the third and fourth quarter. And then I hinted that things might slow a little bit next year. And so you'll see incrementally the 2019 quarter will come down a little bit.
And of course, all of this then plays into GDP. And this morning was a big morning of news data that was being released.
Yes, well, it was hinted at last night, so we thought it would be a strong number. It was a strong number at 4.1%, but as we had discussed this morning, that was actually a little bit less than some of the projections. Some were as high as 5. Bloomberg said that the average was about 4.2, so it came in a little bit less. Nevertheless, it was strong, and when you look at the last 4 quarters, it's averaging 3.1%, which is still pretty strong.
Now, on a somewhat negative side, the dollar, it was unexpectedly strong in the second quarter after really being at the bottom of its trading range in 2007.
Yes, and we'll talk about this later. Obviously, this could impact manufacturers, but when it comes to international returns, when the dollar is strong, it does have a somewhat negative impact on international returns.
And also on the downside, the Federal Reserve continues with its monetary tightening cycle, which on one hand is positive, meaning that the economy is doing well and they can afford to raise interest rates. But that does have some negative impacts in components of the economy. Here we're looking at the Fed funds rate, showing that, again, the Fed has been increasing interest rates on the short side, but this is impacting the 30-year mortgage rate, which we'll see here on this next chart, where the 30-year mortgage rate over the last 2 years has increased and it now is at that 2 or 3 year high of around 4.5 to 4.6%. As a result, we are seeing a slight slowdown in housing, as existing home sales fell 0.6% in June, and they fell 2.2% from a year ago. New home sales fell 5.3% in June. However, even though we're seeing a slowdown on the sales side, home values really have not been impacted as supply continues to be relatively tight.
So in conclusion, the next couple of slides, we're going to go through our economic factor scorecard and some other things, including our dashboard.
So here we have the various components or factors of the scorecard. You'll see, as in prior webinars, we've categorized them between positive, neutral, and negative. We have slightly lowered our view this quarter of housing, which we just discussed, though it does still remain in the positive category. In addition, although interest rates, U.S. politics, the U.S. dollar, and Eurozone growth remain in the neutral category from last quarter, all of these are trending lower with regards to their impact on the economy. Really, the only item that we shifted during this quarter, taking it from neutral to negative, is geopolitics. And we did that as a result of a couple issues.
So some of those issues obviously are the whole trade issues that we've been seeing in the last week, certainly. But other concerns would include the UK's negotiation of their Brexit, and then unrest, whether it's economically oriented or otherwise, in areas such as Russia, China, Iran, Brazil. So a lot more factors that have come up in the recent months than we saw last year.
So if we look at the market dashboard, we'll see only a slight change from the last quarter. So this is the actual dashboard. And of course, we're in the second quarter of 18, and as we look down this, you'll see that the economy, the credit markets, and valuations remained unchanged, with only market sentiment being downgraded to more of a neutral position. Now, we've talked a little bit about valuations in the past, and that has been negative for quite some time. But I think it's worth noting that that can happen, correct?
Absolutely. Historically, valuations really is not a good timing indicator. If you remember back to 2000, obviously stocks were overvalued, but they were very overvalued. So that can persist for a while.
Sure. So looking forward to the end of the year, we don't expect any other major shifts in the categories. And the overall composite at the bottom of this page remains positive. So let's look at the actual composite numbers. So on this page, we'll see the current composite numbers 3.87. So that's represented in that red circle. Although it's true the trend is to the downside, the projected composite by the end of the year is still positive.
Absolutely. And what historically, you need to see that number break through that 3.25 to 3.3 area for the outlook for stocks to be at best even with bonds.
All right, so now let's transition to the markets. We've talked about the overall economic data, but let's talk about the markets. And the markets during the quarter really brought kind of mixed performance.
Yes, absolutely. So here we're showing the different components of the equity markets, the second quarter performance as well as the one-year performance. And you can see that the US large cap, mid cap, and small cap did show positive performance in the second quarter, and actually very strong performance for the 1 year. But below that, we really get to that international section. So when we look at international small cap and emerging markets, they were actually down in the quarter. And we also said that the dollar had an impact there. Now for the 1 year period, they all had positive returns, but they are lagging the US markets on the 1 year basis. And then on this page, we're looking at bonds and other asset class performance. And here in the Q2 area, you're going to see a bit more red. Bonds were actually down just a little bit at negative 0.2%. Global bonds were down more at a negative 4.8%, and that was really dollar related. Commodities were down a bit. And then when we look at long, short, and REITs, they were positive for the quarter. In fact, looking at REITs, that increase of 9.8% was a big rebound relative to the negative performance we saw last year. Looking at the 1 year, again, because interest rates are going up, the Barclays aggregate is down just a little bit at minus 0.4%. Global bonds are still positive. And then you can see really the rest of the segments are still showing positive returns. But again, less than the equity markets.
So during the second quarter, as we look at this chart, we'll see small caps clearly dominated, as they were really viewed by investors as being more shielded from tariffs and maybe the bigger beneficiaries of corporate tax cuts. For the year, however, growth was really the story. It was the clear winner across all market cap segments. And a lot of this had to do with kind of a narrow segment of the economy. If we look at this chart, we'll see the S&P 500. And of course, the S&P 500 performance is made up 100% of the underlying 500 companies that make up the S&P. That seems like pretty common sense. However, if we slice out 4 specific stocks, Amazon, Microsoft, Apple, and Netflix, we'll see that their performance made up 84% of the S&P 500.
Yes, and going further, in fact, if you looked at the top 10, it made more than 100%, meaning that really the other 490 stocks really didn't have a big contribution to the return. Very, very narrow market.
And typically we'll see this type of performance toward the end of a market cycle as returns are consolidating. Of course, all 4 of these stocks also are very growth oriented, which we had already alluded to. So let's look at growth performance relative to value performance. And on this chart, we show how growth stocks, they can come in and out of favor relative to value stocks. When you see the bar for each of those calendar years headed down, that's actually a period in which US growth stocks outperformed. If you look at any of these single years and the bar is trending up, that's a period when US value stocks outperformed. So for example, if you look at the very far right bar, you'll see that year to date US growth stocks have outperformed value by approximately 6 to 7%. Last year, growth outperformed again by a wider margin last year by probably around 16-17%. And the year prior, in 2016, you'll see that value stocks actually outperformed by approximately 10 or so percent.
The other thing to really look at is that year to date in the prior 3 years, there were some pretty big swings. But prior to that period, the swings were much more narrow. So we're seeing a much bigger differential between growth and value, and that can shift even on an annual basis.
Well, and on the next chart to that point, we're going to show you another way to look at this relationship between growth and value. Here we show kind of the 10-year trailing relative numbers between the Russell growth and the Russell value. So if the line is in that bottom half section of the chart, that's a period where values essentially outperformed, or maybe value is perceived as being overvalued. The top half are periods when growth has outperformed, or again, another way to think about it is maybe growth is overvalued during those periods. And it's clear that this is cyclical, that there are times in which value does better and there are times in which growth does better. And this chart really points out that we may be toward the top end of the range in this growth cycle.
Yes, and as you had kind of mentioned prior, we could be in the later stages of a cycle, and so that very strong growth performance that's been very narrow could be signaling that we're closer to the end. We don't know the exact timing, but we do believe that certainly fundamentals for growth stocks have been very, very good, obviously, but they've also been recognized by investors. Now, this could have an implication for active managers, as several studies have shown that active managers do better when value is in favor and passives do better when growth is in favor. We've seen active management do a bit better in recent years, kind of despite this. But obviously, based on kind of that evidence, if we start to see value doing a bit better, then active managers might have a tailwind.
Sure. So now let's look at international stocks and how they fared during the quarter. So although they've done well over the past year, second quarter wasn't so.
Yes, and in fact, when you look at it, it was fairly broad-based. Really looking at most countries, the UK was slightly positive, but most everything else was negative. Especially if you look at the right side, you'll see the European companies, but more importantly, we saw a bigger downside on the left side, which really shows kind of more of the emerging market and the more volatile countries in Latin America.
On the next chart, we're going to review that same long-term relationship that we looked at between growth and value. We're going to review that looking at international and US. So here we'll see, again, similar chart to what we just reviewed a few charts ago, but here the bottom half represents periods in which international stocks have outperformed, while the top represents periods in which US stocks have outperformed. So this year, obviously, US stocks are doing better, while last year in 2017, international outperformed.
When you look at really the last 10 years, US markets have outperformed in 7 of those years, but as you can see from the bar charts, that gap was fairly wide. But really, it's cyclical, so you also have to look back at the prior 10 years, and interestingly, the relationship was flipped. International outperformed in 7 of those years, and interestingly, it had a 6-year period in which they outperformed every single year.
So one of the questions I think we get, Jonathan, is with the US outperforming kind of so consistently over the past couple of years, or at least the differential kind of favoring the US, why do we invest internationally? And I think there's a couple of responses that we can give to that relatively common question. First, if we look at this chart, we'll see in 2009, obviously that's the bottom of the Great Recession. As you look at the gray line, at least I believe it's gray, I'm colorblind, so it's gray. You'll see a real strong recovery in the US markets. But if you look at the bluish line, that represents the international market. So although they've had a recovery, it's been at a much less magnitude than what we've experienced here in the US. So a lot of analysts and such believe that really this represents the fact that the US markets are maybe a bit overvalued, while the international markets still have some room to run. Another way to look at it too is that we're not the only option in the US. As a matter of fact, when we look at global market capitalization, US companies only represent about 32% of the pie. So by being too home biased or too focused just on US stocks, you're really giving up a lot of opportunities that are elsewhere in the world. Now, it is true that not all of those other markets have as liquid of markets as we see in the US. Not all of them are as investable as what might be the case in the US. So if we look at the MSCI ACWI, which is the All Country World Index, which I think is probably a better proxy for investable global equity markets, still the US only represents about half the pie.
And in fact, if you look at it that way, emerging markets make up 12% of the global market cap. If you don't have international holdings, you're missing Japan. So you're missing a good bit of Asia. And in the next one of our next slides, we're going to actually talk about what that could mean by not having that exposure.
Well, and it could mean a significant lack of exposure to some of the parts of the world that are going to be growing the fastest over the next 20 years.
And in fact, looking here, the yellow bar charts is kind of showing what spending was back in 2009. And so you're going to see to the far left, North America and Europe really were a predominant part of that share. But interestingly, when you look at the 2030 projected numbers, we're going to see just a little bit growth in North America. We're going to see some growth in Europe, but by far you're going to see in the Asia Pacific region, that growth rate will really dwarf everything else. And again, so not having holdings that are Asian or emerging markets, you're really not going to get the benefit of where the global growth in spending is projected to come from.
Yeah, so again, being that home biased, or at least too home biased, you're missing out on some good opportunities from potentially a valuation perspective, from just restricting your playing field as a whole, and restricting opportunities in some of these markets longer term that likely are going to provide good growth. So now let's transition our discussion to bonds.
So for the 1-year return, we had some mixed performance. We had some categories that were positive, some were negative. You'll see on the far right, Treasury bonds were negative, and that was really because of the increase in interest rates. And then when we look at the second quarter, we saw very similar patterns, not as dramatic, of course. Now, on the far left, you'll see that emerging market bonds were down more than 2%, and that was really based on the dollar. But when you look at the Barclays aggregate, you'll see that returns are negative, but fairly muted. And then when we look at municipal and TIPS, they were positive in both cases. Municipals, they were probably hit a bit more last year, so they've kind of made a nice comeback, and TIPS have done well because inflation expectations have increased.
And of course, we already talked about the increase in the Fed funds rate with the Federal Reserve on their monetary tightening process. As rates have risen, particularly on the shorter side of the yield curve, we have seen the overall yield curve flatten over the past couple of years. So on this next chart, we're going to show how that has occurred. So the blue line represents the yield curve as of 12/31/2013. If you look at the left side of this chart, you'll see the short-term yields. The right side represents the long-term bond yields. And again, in 2013, the yield curve was relatively steep. You got paid more for the longer-term bonds, considerably more than you did for the shorter-term bonds. That obviously has transitioned. So the shorter end of the yield curve has shifted up, and the longer term has actually shifted down a bit, creating a flatter yield curve as those short rates have come up and the long rates have come down. So why is that important? You know, why do we care that this yield curve is flattening?
Well, one of the things that historically we've seen ahead of recessions is a flattening, but the fear is that at some point the yield curve becomes inverted. So while the Fed is raising short-term rates to cool things down, investors start to worry about that growth slowing, and then you see those long rates come down. And an inversion, which we'll show, is when those short-term rates are higher than the long-term rates.
And we actually have that here on this chart where we see the difference between the 10-year and the 2-year Treasury, with the 3 circles representing those inversions that you just made mention of.
And then if you look, you'll see the gray shaded area. That's actually when the recessions hit. And so the point is that inversions are important and people watch them, but they tend to happen before the recession, meaning that there's a period of time when the rates invert, but the economy is still doing well.
And the next couple of charts we have will kind of show how you want to be a bit cautious in using this inversion as a tool to get out of the market, because you really could be missing some upside opportunities. So here, as we look at this, we see the start of the inverted yield curve for different time frames, so August of 1978, September 1980, so on and so forth. Then in the second column, we have the start of the market correction. And the third column represents the lag between the inversion and the market correction. So again, just because the yield curve inverts doesn't mean the market's going to immediately transition into a bear cycle.
And I think that distinction is important because on the last column, we are showing you what those corrections were and the magnitude, but there was a period before that time frame where stocks actually did something else. And in fact, we'll show that on the next chart. So on this chart, we're looking at a couple of different measures. On the far left, you'll see the dates of when the yield curve broke below 35 basis points, meaning that we wanted to show when they started to go down, because that's obviously when investors start to talk about it. And so right now we're at 25 basis points, and there's a lot of articles out there about, is it inverting? When is it going to invert? Then on the second column, we show the time period when it actually inverts. And then the third date is when that inversion kind of troughs. So there's also a gap in those periods. And in fact, if you look at that December 1994 period to June of 1998, and then the trough occurring in April of 2000, if you had decided to get out of the market in December of 1994 based on this kind of signal coming up, you would have missed a very, very long and big rally in the market. Now, the other periods aren't as dramatic, but what we wanted to show is that when people start talking about the yield curve inverting, doesn't mean that stock returns are immediately going to be negative.
Good point. So again, in summary, our market dashboard is still showing us in positive territory. And although, as we went through, the trend is probably down, it still, at the end of the year, is projected to be in positive territory. With that, let's now transition to those follow-up questions we received from prior webinars and in prior client meetings. So the first one, is SilverOak concerned about the increasing budget deficit and outstanding debt? And then how could this impact investment decisions? And the second one we'll talk about is, how does SilverOak decide where to invest money in client portfolios? So getting back to that first question, there's many ways to come at that debt question, politically, economically, from a market perspective, so on and so forth. We're going to try and stay out of the political arena. Nonetheless, I think it's fair to say most people don't feel the trajectory of the debt level is a positive thing. On the other hand, not many people seem courageous enough to do anything about it. Really, there are only a couple of alternatives to fix this. Either you raise taxes, you reduce spending, or you do some combination of the two. And frankly, it's going to likely require some combination, as it's hard to see how taxes could be raised enough to fill the gap, at least not without negatively impacting the economy, nor is it probably reasonable to expect spending to go untouched. And Jonathan, you're going to go through that here on this slide.
So this is looking at the 2018 federal budget. Total spending is 4.1 trillion. And so when we look at the left bar, that shows the spending for the year and kind of the components. And so you'll see at the bottom Medicare and Social Security. They make up roughly 50% of the budget. Then the next two items are defense and discretionary spending, and they make up about 30%. Then we have some other things, but I want to point out that with rising national debt, we are paying interest on that, and that comes out to 8%. If we look at the right bar chart, you're seeing actually that there's a gap. And so let's look at that top number, borrowing. For this year, it's projected to be $804 billion. That means that the Treasury has to go out and issue bonds to pay for that gap versus the spending. And then on the other side too, I'll say, we always talk about cutting spending, but what spending can we cut? Again, discretionary and defense makes up about a third of the budget.
And a lot of people don't want to touch defense.
Right.
And it's not very popular to talk about reducing Social Security or Medicare.
Right, and then the other side too is that as national debt increases and as interest rate increases, that interest payment, or 8% of this budget, that's going to probably go up.
Sure. This chart is essentially showing that issuance of debt and the increase that we've seen.
Yeah, and so here we're showing net new issuance on an annual basis. And so during the years where we were kind of in tighter budgets,
we had the sequester.
You really didn't see any major changes. But in 2018, you can see it's a very dramatic change, and net issuance is projected to be up 10%, again, because of that $800 billion gap.
And as you mentioned, as the issuance of bonds increase, the financing increases, and the carrying cost of that also increases. And that leads to this, where the federal deficit as a percentage of GDP increases.
And it's really going projected by 2028 to reach 96%. So thinking of it another way, the budget deficit will almost equal the economic output of the country in a given year.
And you know, at this point, I think the question still is, why does that really matter? So on this chart, we show that as that percentage goes up, the debt relative to GDP increases, the projected GDP or growth goes down.
And so by 2028, again, reaching 96%, based on the historical studies, we're likely to see GDP growth below 2%, so somewhere in that 1.5% level.
So getting back to the question that was asked, are we concerned about the increasing budget deficit and outstanding debt? The answer is obviously yes. How does this impact our investment decisions? Well, really in the short term, it doesn't. While in the long term, we are aware that growth in the US will likely slow as a result of this if the trajectory continues. So as that time approaches, we'll obviously assess the situation and respond accordingly, which really leads us to the next question, and that is, how does SilverOak decide where to invest money in client portfolios? And as with most questions, this one's complicated, but I think it's probably best to start with our overall investment philosophy. So first, we customize each portfolio based on overall risk profile. What does risk profile mean?
Well, we start really with one aspect, and that's your ability to take on risk. This encompasses your goals and objectives. So is it retirement planning or any other sort of planning goals that you have? And it somewhat is based on your age. And then, of course, it is also takes into account the level of your assets and your time horizon.
And maybe even more important, your willingness to take risk, or what we refer to as that sleep at night factor.
Yeah, because we could put you into an allocation that you might not feel comfortable with, and then it's much harder to maintain an investment portfolio that stays stable over time.
Sure. And I really think we're in a unique position to help assess a person's true risk profile, since we're typically working with our clients in a very comprehensive fashion. Because the risk profile is really going to be impacted by a whole multitude of factors and issues. And since we are so comprehensive and we get so intimate in our relationships, it helps us in developing that risk profile and matching it up with our client's true ability to take risk or accept volatility. We're also really well positioned to assist in making certain clients aren't making investment decisions based on investor biases, which are sometimes really hard to overcome. And we're actually going to be writing a white paper sometime over the next 6 months addressing this issue.
Right, and it gets back to that being able to sleep at night. If the portfolio doesn't really match your willingness to take on risk, then there's that chance that we might get a call from you that says, I can't take this volatility. Mm. And so then our job is to really help you work through that. And of course, part of that would be arriving at a portfolio that you feel comfortable with.
And we actually have some examples of different portfolios. At the bottom here, you'll see the allocation of stocks relative to bonds. At the far left, you have a very conservative portfolio, maybe overly conservative at 100% bonds. At the far right, you have an all-stock portfolio. Obviously, the all-stock portfolio is going to have a higher average annual return of 10.2% relative to an all-bond portfolio that's at 5.1%. But maybe more important, as we think about risk profile, if you're in that all-stock portfolio, are you willing to accept that level of downside risk? Whereas if you had, as an example, a 60-40 allocation, 40% stocks, 60% bonds, that downside would be muted significantly. Not that one of these is right or better than the other, but the goal is to pair this up with your willingness and ability to take risk or downside volatility. Now, part of SilverOak's investment philosophy is also not to shoot for the fences, because we don't want to strike out along the way. Striking out can be very damaging to a portfolio. And there is this ironclad rule that, Jonathan, you've mentioned many times, and that is that with investing, to make those higher returns, you have to be willing to take on more risk, which can lead to big losses. So again, we're trying to minimize those big losses. And the reason is that the bigger the loss, the more you have to earn just to get to break even. As an example here, if you lost 10% of your portfolio value, you would have to earn 11% just to get to break even. Now, that frankly doesn't seem like that big of a difference. But as you have more downside, you need to earn more to get to break even. And the numbers become pretty staggering at these bigger downside risk levels, where if you lost 50%, you'd need to make back 100, or you lose 60%, you need to make back 150% just to get to break even. So again, avoiding those big losses means that you don't have to swing for the fences. And that is part of our overall investment philosophy. Of course, once we determine your overall risk profile, we develop a diversified global target allocation for you, which gets documented into your investment policy statement. So what does this global target allocation look like? Well, first, it's constructed using modern portfolio theory. We really haven't talked a lot about that, but that's trying to optimize the portfolio based on certain risk profiles.
And that really comes down to diversification. And so that's balancing risk to achieve your investment objectives. We diversify across different asset classes. We diversify across regions, so US, international, market capitalization, small, mid, and large, investment strategies, growth versus value, and other strategies, which would be kind of our other category. And then we utilize a glide path, so the asset allocation adjusts over time as you age. Your time horizon becomes lower, and as a result, your allocation will change.
Objectives change.
True.
You start achieving certain objectives that you can kind of check off the box. So once we have that target allocation, we really achieve the underlying positions within it using our IQs positions, or what we refer to as investment quality scoring system. And this is a proprietary method to evaluate investments. It uses both quantitative analysis, or the numbers, as well as qualitative. And I think it really enables SilverOak to evaluate all managers in a category with a similar methodology, and to narrow those candidates down to really what we refer to as a best of the best list. Now, this process, the investment quality scoring system, requires that each position be approved by our investment committee. And to do so, the committee has to be convinced that the investment has an ability to consistently meet the rigorous due diligence criterion we've laid out. At a very high level, all of the positions have to be low cost, they have to be transparent and tax efficient. But of course, then we start drilling down into all of the details on the quantitative and qualitative aspects. And of course, the IQs process involves a continual monitoring and evaluation of these positions and the markets. Now, that ongoing monitoring does sometimes result in adjustments that can be made based on various factors. As an example, sector allocation weightings get out of line. Or there's underlying issues with a position. Either the quality has been impaired, the original investment thesis maybe has been impaired, or there's been a change in management. There's a whole flurry of reasons that could result in a change in the underlying investment or IQs position.
There are a couple of other things too, though. One is that the macroeconomic conditions could have changed. We've been talking about many of these things, but that is something that goes into our assessment. Overall risk profile might change. And so as a result, with that change, your allocation might change, and the type of investments within the allocation might change. And of course, we've talked about kind of the behavioral biases, and being able to stay in a portfolio versus wanting to buy and sell at the wrong times is very important.
And that really maybe is best shown on the next chart, where we lay out various asset classes and portfolio allocations relative to the average investor. And of course, none of our clients are average investors. We all are from Lake Wobegon. But you'll see here that over a 20-year period, REITs have averaged about 9%, gold around 7%, the S&P around 7%, a 60-40 portfolio of stocks and bonds around 6% annualized, oil's right there with it, international's just a smidge behind. Of course, long-term bonds usually don't make as much as stocks, but the number that's, I think, amazing to see, and there's a lot of studies that show this, the average investor is at 2.6%, just ahead of inflation. Why is the average investor so much lower than most of these other numbers? And I really believe, and again, there's a lot of studies that can support this, these folks think they can either time the markets or maybe even read the markets. For example, many investors, they just get out at the wrong time during maybe intra-year declines, only to miss what ends up being a good year in the market. So let's look at those intra-year declines that, come to find out, are relatively common. So Jonathan, what we're showing here as an example at the far right, year-to-date 2018, the S&P 500 up just slightly. But at some point already during this year, really probably in that February timeframe, the S&P was down as much as 10%. So people that got concerned, they didn't have the right risk profile. They did what you were just mentioning, and they got out at the wrong time, have missed the recovery thus far. Now, we don't know if the year will end positive or not, but there are a lot of examples here as you look back over these calendar year numbers where there was a significant decline at some point during the year, and yet that year ended in positive territory.
I think the other thing to glean is that there are many more positive years than negative years. And so by getting out during the middle of the year or whenever that decline occurs, you can't participate if the market is up that year.
Great point. And another reason why you really should try to avoid some of these investor biases we've referenced, and again, we'll be writing a white paper on, is shown here in this chart. This is the S&P 500 average return between January 96 and December of 2015. It's up on average 8%. If you miss the 10 best days, only 10, your return would have been cut essentially in half. Now, what's even more surprising is 6 of the 10 best days occurred within 2 weeks of the 10 worst days. So again, that volatility can go both ways, and sometimes it's bunched, and you'll see the volatility both on the downside as well as the volatility on the upside in a very narrow trading cycle or during a very narrow period of time. Just another reason to stick with a strategy that's consistent with your overall risk profile. And this really speaks to that as well, where if you stick with that strategy over periods of time, you'll see that the volatility actually narrows over those longer periods of time. Whether you're in an 80-20 portfolio, a 60-40, or a 40-60, they all narrow over time. So, in summary, our investment decisions for client portfolios are made based on the following keys to a successful investment strategy.
Identify your true risk profile. Develop a strategic allocation that's on the efficient frontier, meaning that you're getting an appropriate return versus the risk and that it's diversified. Selecting IQ's positions to fill that allocation. We continually monitor the portfolio and the underlying IQ's positions. We'll reassess your risk profile throughout the market cycle. And then we manage behavioral biases and help you stay invested. And as Shannon mentioned, we'll have a white paper out later in the year where we outline what those biases are, why they're not helpful in your overall long-term strategy, and then how we can help guard against them.
So with that, as I mentioned at the beginning of the webinar, we welcome additional questions and or topics that you would like to hear in future webinars. You can submit that with your SilverOak advisor. If you're not working with a SilverOak advisor, you can call me directly at 952-896-5701. Otherwise, both Jonathan and I and the rest of the SilverOak team want to thank you for your participation and wish you a wonderful day. Bye-bye.